Having $10,000 saved for retirement might seem like a lot, but would that amount be able to cater to your needs when you retire? How about you invest that amount and see it yield enormous dividends? The dividend could, however, supplement your income and even give you more than enough money to retire with. In today's video, I'll show you different ways you can invest $10,000 and have it yield dividends. Make sure to watch till the end to learn about mistakes other investors made and how you can maximize your investment. Don't forget to like this video and subscribe to this channel. A lot of investment options provide various levels of dividend income. The most common of these investments is the S&P 500 index. It's so popular because it provides exposure to 500 large U.S. companies that have a history of stability and profitability. It's also well-balanced, allowing you to own parts of each sector in the industry that make up the entire stock market. The S&P 500 is highly recommended by Warren Buffett, and it has a long track record of healthy results. When investors say the market, this is what they're referring to. If you purchase an ETF for an index fund and attract the S&P 500, you'll receive a dividend yield of less than 1.5%. This is because most of the largest holdings are technology companies, which are known for paying little to no dividends. With the $10,000 investment, this index will only provide about $150 per year, or $12.50 per month in dividends. Another one of the most common investments is the Dow Jones Industrial Average, or the Dow. This is another index that investors commonly refer to as the market. The Dow consists of 30 of the largest U.S. companies and is seen as the second indicator of how the United States economy is doing. This investment comes in second after the S&P 500. When investors purchase a fund that attracts the Dow, they will receive a dividend slightly higher than the S&P 500 at just over 1.5%. An option that would receive a higher dividend yield would be to purchase a fund that focuses on providing higher income and less capital appreciation. Many high-quality options hold stocks of stable companies that have a long history of dividends. One example is the Invesco S&P 500 High Dividend Low Volatility ETF. This provides a dividend yield of around 4%, which is significantly higher than the overall S&P 500. Instead of owning each company in the S&P 500, it only holds the ones that pay the highest dividends. This has incredibly decreased growth over the term. With $10,000 of this fund, the annual dividend income will be around $400 or $33 per month. There are many other high dividend funds available that are ideal for older investors. The reason older people like this fund is because they tend to provide more stability, which is beneficial to older people. They perform better during bear markets and much worse during bull markets. With market stability combined with a regular income, it's no wonder these are popular among retirees. Another way people can achieve higher than average dividends is by selecting a sector-specific fund. This kind of fund holds companies in one single sector or industry, such as real estate, healthcare, energy, and many others. Some sectors provide higher dividends due to the nature of their business. The price of these sectors are relatively low and has a higher dividend yield because many investors are scared away by the volatility due to the economic fluctuations, renewable replacements, and regulations. For example, the Vanguard Energy ETF has a dividend yield of over 3%. Real estate investment trusts are also considered a little risky, and because of their business structure, they pay the majority of their profits to shareholders in the form of dividends. The Vanguard Real Estate ETF also has a yield of more than 3%. For investors that are willing to do some research and purchase sectors that have fallen out of favor, they have the power to achieve high returns. These returns would come in the form of dividends and capital appreciation as the sectors roll back in their favor. If you invest $10,000 in Vanguard Real Estate or Energy ETF, it will provide up to $300 per year or $25 per month income. Another option is to purchase individual stocks. Beginner investors that don't have a large portfolio are advised to only purchase index funds or ETFs. This way, you can learn about market behavior, receive stable returns, and grow your portfolio without taking too much risk. Later on, you might decide to select individual stocks if you're willing to do the research and take the risk. If you finally make a decision to purchase individual stocks, it might be a good idea to look for a history of dividend growth. For example, the list of dividend aristocrats is a good place to start because each aristocrat has a history of increasing its dividend for 25 consecutive years. A dividend aristocrat like ABBV currently pays 4.5% dividend. Assuming you invested $10,000 in this company, you'd receive about $450 per year or $37 per month in dividends. You would also receive any capital appreciation or depreciation depending on the future stock movement. Furthermore, it's always advisable to screen those prospects by their fundamentals, making sure they have reasonable payout ratios, around 50 to 60% or less positive earnings, and various other potential metrics. There are deals to be had with individual stocks because they often get sold off, whether it's due to some recent bad news, an earnings miss, or new management. This could also present an opportunity because the stock market tends to overreact. A savvy investor must assess the severity of the news such as this and make their own decision regarding the stock price. Since most investors who have $10,000 or are ways off from retirement, they should seriously consider ignoring dividends entirely. Why? Because investing in growth stocks has the potential to make you much more money over the long term. It's advisable that those who are still young should seek growth because dividend-paying investments historically have lower overall returns. A 2% difference in your annual rate of return can make a huge difference over your career. For example, someone who invests $10,000 once at the age of 25 and earns an 8% rate of return until age 65 will have $217,000. If they had earned a 10% rate of return, they would have $452,000, or more than double the money by age 65. It's important to consider that growth stocks are sometimes more unpredictable, which can be difficult to handle for investors who are new to market fluctuations. A perfect option for younger investors is an ETF such as Vanguard Growth ETF or VUG. Just as the name suggests, it holds large-cap growth stocks such as Amazon, Home Depot, Apple, and other prominent stable names. Over the long term, a growth index will likely outperform the S&P 500, which is ideal for someone who has many years until income will be needed. The dividend yield from VUG is less than 0.5% because most of the holdings pay little to no dividend. Instead, they reinvest the profits within the business to continue growing at a rapid rate. Because of this low yield, a $10,000 investment would only yield less than $50 per year in dividends, or about $4 per month. There are many other options similar to this fund that provide returns that historically exceed the overall market. A lot of times, people become obsessed with dividend yield and choose the wrong investments for their timeline. An investor with a portfolio size of around $10,000 would be better off focusing on growth and ignoring dividends entirely. How much difference does the income make in your life? Whether it's $50 or $400 per year, that amount isn't likely to amount to much when it comes to paying bills and funding your everyday expenses. Growth stocks will, however, provide you with more money in the future when you're getting ready to retire. Finally, at that point, you could switch your growth investments over to income investments, if it makes sense. Don't make the mistake of focusing primarily on debit yield early on. Don't forget to give this video a big thumbs up if it was helpful. If you're new to our channel, make sure to subscribe and turn on post notifications. See you next time.